All right, I think it is time for us to get started here. Welcome to the Capital Assets and Depreciation webinar, follow-up from the November 2021 bookkeeping workshop. I'm your host, Haley Trefen from the Library Development Office at the Indiana State Library, and Paula Newcomb from the Professional Development Office is also here. Over the next couple of hours, Susan Gordon and Todd Caldwell from the State Board of Accounts will be leading us on a deeper dive into accounting for capital assets and calculating depreciation. If you have a question during the presentation, type it in the chat, but make sure that you are sending it to everyone, not just the panelists, because I think you'll find that other people will be interested in the answer as well. And at the end of the presentation, I will post a link to a form you'll need to fill out in order to get an LEU certificate. This presentation will be recorded and a copy of the presentation will be made available on our YouTube page and our LDO workshops page, the latter of which will also have any materials from today, like the slides. So having said all of that, let's begin.
Well, good morning, everybody. It's a nice chilly morning here where I am, so I hope you're all able to stay warm this morning. And thank you for being here with us to look a little deeper into capital assets and depreciation. We realized that the amount of time we had allotted for that in November was not sufficient. And so we hope that this is helpful to you today. Also, as we're going through this, if you've gotten the slides, you know that there's a lot of them. So we'll stop at certain sections and ask for questions at that time. And Haley, if you can help us with those, to read those to us from the chat, that would be great. So with that, we'll go ahead and get started. What I want to start out with first is what the AFR looks like. Now, this was from 2020 for capital assets. Remember that for capital assets, there was a phase-in of accounting for capital assets for purposes of the annual financial report and the financial statement note. So in 2020, the capital asset schedule changed and you were required to report for each type of asset, the beginning balance as of January 1, your additions for the year, your purchases, your reductions, and that would be things that you have removed, and then the ending balance as of December 31, 2020. And that's the information that was required in that first phase. Now for 2021 is our second phase of incorporating information for capital assets into the annual financial report and subsequently a note to the financial statements. So now the schedule is going to look different. It has three different categories there. You're going to have non-depreciable assets, which is land, construction in progress, and other non-depreciable assets, which for libraries would be something like artwork or a rare book collection, something like that. Same information is required on this part. It's just right out of your capital asset ledger, your beginning balance, any additions for the year or reductions, and then an ending balance. So that's that first top section there. In the middle section, this information also is right off of your capital asset ledger for depreciable assets, and you have everything else listed there, all the other types, like infrastructure, buildings, improvements other than buildings, machinery, equipment, and vehicles, and then books and other. So this too should be right off of your capital asset ledger. You'll have your beginning balance, additions, reductions, and ending balance. So basically those first two sections on this 2021 AFR are the same as it was in 2020. It just looks a little different. In 2021 though, we're adding depreciation. And those, of course, will only be for depreciable assets. So you won't be doing any depreciation on the land or construction of progress or artwork and those types of things because they don't have they have an indefinite useful life. But for the other categories like infrastructure, buildings, improvements other than buildings, machinery, equipment, and vehicles, and books and other, you will be calculating accumulated depreciation. So, and you can see there, one thing that we have to work on is making sure that you have a beginning balance as of January 1 of 21 And we'll show you some examples on how to do that in this presentation. And that is going to be as if you were depreciating your assets all along. So that's that beginning balance. And then the additions would be what your annual depreciation amount would be for 2021. And then reductions would be generally if you've removed an asset from your capital asset ledger, then you'll remove the accumulated depreciation that goes along with that asset. And then you'll have an ending balance. So what we hope to do in these next several slides is to go through each category and talk about that. But first, let's do some background work on what a capital asset is. A capital asset is an asset that's owned by your library. It would have a useful life extending beyond 1 year, and it meets the threshold set by the library board in the capitalization policy. Now, we've talked about that capitalization policy before, and that is the amount at which your board believes that an asset is material to the financial statements. I don't have a number to give you. I can tell you that I've seen on the Government Finance Officers Association website, they recommend nothing less than $5,000. Other places might want a threshold much less than that. Some may want one that's more than that. It's really up to your board as to what's considered material to your financial statements. And then, of course, we've talked about the categories of capital assets already: land, infrastructure, buildings, improvements other than buildings, machinery, equipment, and vehicles, and then books and other. Okay, and then depreciation. And what is that? Depreciation is just an allocation of the cost of an asset over the estimated useful life of that asset. And those are only assets that have a determinable life. So that's why you don't depreciate land, because you don't use up land. It has an indefinite useful life. But the useful life is an estimate of how long an item of property can be expected to be usable. That can be based on your own experience, or that can be based on a table that you find in a book somewhere of, reasonable estimated useful lives for particular kinds of assets. And this should be included in your policy, or maybe a reference to the source of information that you're using. For example, a lot of places will consider machinery and equipment to have an estimated useful life between 5 and 7 years. Based on your experience, it may have you might want to put 5 years down. Another library may have an experience of 7 years for those types of assets. So those are the types of considerations you'll need to put in your policy. And then why are we doing depreciation? Well, one reason is that it's information that is needed by our financial statement users. We have been told that this is valuable information for them. An example for that would be the bond rating companies. We've kind of talked about that over the last 2 or 3 years, that we are pulling in additional information into our annual financial report and financial statements so that the financial statement users have all of the information they need to make informed decisions. So capital assets is one of those categories. We've talked about debt and short-term debt and some of the other schedules that have been added on as well. And then this has been prescribed as a result of that by the state examiner under his authority to do so. Now, capital asset policies that you need, again, we've talked about these, but just to review, one is that capitalization threshold. Again, that's your board policy stating the threshold at which an item is considered a capital asset for financial reporting purposes. And only those items that exceed that threshold are placed on the capital asset ledger. For example, if you have a tractor that you purchased for $8,000 for the groundskeeping, then you would show that on your capital asset ledger if it exceeded your threshold. If you purchase a laptop that's only a few $100s and that doesn't exceed the threshold, you don't need to put that on your capital asset ledger. Now, that doesn't mean that you don't go ahead and account for that laptop in some manner. It just means that for financial reporting purposes, it's not on the financial statements listed as a capital asset. Estimated useful life, again, that's your board policy on what standard or what category they're going to be using for the number of years that an asset will be allocated. And then your depreciation method, that's the allocation of cost of the asset over the estimated useful life of an asset. The most common one that's used is straight line depreciation. Okay, for the capital asset ledger, hopefully you all are familiar with the capital asset ledger. That just records the assets that you have that have exceeded that threshold and any purchases and disposals of capital assets. When you do record a capital asset on your ledger, it is recorded at historical cost, which is the amount that you purchased it for. If you don't know, if you have an asset and you don't know what the historical cost of that item is, then there are ways that you can estimate that. And one of the most popular ways is use of the consumer price index tables. And we have information on that in the June 2020 bulletin. And what we're looking for here is a reasonable estimate. And when we get to the next slide, we'll go over an example of how to use that table. And then, of course, on the capital asset ledger, the assets are categorized by those various asset types. So here in the library bulletin from September of 2019, we have a picture of the columns that are necessary for the capital asset ledger. So you have your date of purchase, you describe your asset, if there's any identifying number, where it's located, and then the original cost. There is a column there for the estimated useful life. If you dispose of it, there's a column there where you can record that information, the date. And then you can see that you have the various types of capital assets in column form in the next section to arrive at a total capital assets column. Now, we talked about you might have to estimate the cost of your capital assets. So here, this is an excerpt from the June 2020 bulletin, and those are all available on our website, and we do send those out to those who subscribe to our emails. So when it's not possible to determine the historical cost of capital assets owned by a governmental unit, the following procedures should be followed. Develop an inventory of all capital assets which are significant, for which records of historical costs are not available, and obtain an estimate of the replacement costs of these assets. And then through inquiry, try to determine the year or the approximate year of acquisition. And then you're going to multiply the estimated replacement cost by a factor on the consumer price index table of cost indexes. And that result will be the estimated cost of the asset. So you can go ahead to the next slide, Todd. So if we have an example here, this is just an excerpt from the table. If you have a building that is estimated to be worth $76,000 now, or that is the replacement value, and the building was constructed in 1946, then your estimated cost would be $6,080, which would be your 76,000 times that factor of 0.08 to equal $6,080. And we'll go over this a little bit more in some of the examples that we have. And you can also read more about it in the bulletin. Okay, for capital assets, as far as depreciation is concerned, the most popular method, the best practice method, I guess, for most assets would be straight line depreciation, where you apply that to individual assets. And we have the formula here for you on this slide. Annual depreciation is going to equal historical cost divided by the estimated useful life. And we'll go over some examples. Accumulated depreciation then is the annual depreciation that you've calculated times the number of years that that asset has been in service. Now for your library materials, and we'll go over a couple of examples for those, you're going to need to use the composite method of depreciation because you won't want to, each book does not meet the threshold, but circulating library materials is the major function of a library, so it is significant to the library's operations. So you'll want to group those items, those books and circulating materials. But the calculation for the group is the same as it would be under straight line depreciation. It's still the annual depreciation is a historical cost divided by the estimated useful life. And accumulated depreciation is that annual amount of depreciation times the years of service. Now, there's a couple of things you might want to remember. You do not calculate annual depreciation once that asset is fully depreciated. So what that means is if I have a fence, we'll talk about this in a little bit. If I have a fence that is estimated useful life of 10 years, once I hit that 11th year, I'm not going to depreciate that fence anymore because I've already allocated the cost of that fence over its estimated useful life. Then you're going to remove accumulated depreciation upon disposal. So if we talk about that fence and it was originally $5,000 and I've fully depreciated it, then I'll remove that $5,000 of depreciation from accumulated depreciation. We'll show you an example here in a few minutes. And then one other thing that might make things a little easier for you is when you purchase an asset, you can go ahead and recognize a full year of depreciation that year, no matter when you purchased it during the year. That should be part of your policy. You don't have to do that. Excuse me. Sometimes people will recognize a half a year in the first year, but to me that's just complicated because you got to remember to do half of a year in the first year and half of a year when you dispose of it. So you can adopt a policy to recognize a full year in the year of acquisition. Okay, now remember on the AFR we had 3 categories, and that first one was non-depreciable assets. Excuse me for a moment. Those would be land, works of art, historical treasures, artifacts, and things like that that don't have a determinable life, and also construction in progress. Now, the first one we need to deal with is land. That's included on your capital asset ledger at historical cost. That's the same thing as acquisition cost. Oh, you know what? Before we get into land, Haley, do we need to address any questions up to this point? I know there's a lot coming in.
We have many questions. So
yeah, I thought so.
do you want to start from the beginning?
Well, we might as well. Let's go ahead and get those questions out of the way before we move into the examples.
Let's see here. Earliest one I had was from Jason at 10:05. He said, Susan, I want to understand why we need to calculate depreciation. I understand it from a business perspective, but for libraries, it doesn't make sense to me. It just seems like a lot of extra work for nothing.
Well, like I said, and Todd, you can add to this, the financial statement users have indicated that they want this information in our financial statements for purposes of making their decisions. And one of the main players in those financial statement users are bond rating companies. And I think if you can look at it like depreciation is again allocating the cost of an asset over its useful life. So if a financial statement user can look at the total number of or the historical cost of all assets and the accumulated depreciation on those assets, I think they can get an idea of the resources that are going to be needed in the near future to replace those assets. So that gives them some idea of how to do that. Now, I know that we have heard there's a lot of estimation involved in this, and that's true. This is not dollar for dollar always. It is an estimation to give the financial statement users an idea of resources that may be needed in the future to replace those assets. And Todd, do you have anything to add to that or correct me if it need to be?
No, what you said was correct. But I just want to remind everyone in the estimation, estimating for these purposes is an acceptable practice. And I know sometimes it might seem like, you're just picking a number, but as long as that number is reasonable, it isn't anything we are going to take exception to in an audit. So you're not going to get dinged on it unless you built a building last year and you said all your records got destroyed and we are valuing it, or our cost was $1. Obviously you didn't build something for $1 last year, so that doesn't seem reasonable. Just as long as it's reasonable, your estimate, document that you've estimated it. If you used anything to base your estimate on, document that. You found it on the internet, or you went over to your reference section and you looked up in a book and noted that might be the approximate, cost of it. So estimates are okay. I know it seems a little contrary to what we're doing in a normal day-to-day practice, where we, some people want to balance to a penny when they do their bank reconciliation or something like that. But in this case, just keep that in mind, that the estimations are an acceptable practice, and that as long as it's reasonable, we won't have any issues with it.
Okay, next question. Can the threshold amount be changed by the library board at this point in time?
Yes.
There are a few people asking for recommendations on consultants to help them with that. And so some people are posting those in the chat. Let me see here. Will the depreciated amount be subtracted from our budget somewhere?
No. No, it's not really. It doesn't really have anything to do with that at all.
Would books that have been lost and or weeded from our collection be considered depreciated from our collection?
We can go over a couple of examples of that toward the end. I think it'll cover that.
Okay. If our threshold is $500, only if a single book was $500, would it count?
No, for library books, because that is the main function of the library, those would be shown as a group. And so if you spend, let's say your threshold is $5,000 and you spend $6,000 on library books that year, then you would group those library books and show them as the asset for that year.
I've seen references to composite depreciation. Can you explain that?
We will be explaining that, yes. But that is basically calculating an annual and accumulated depreciation on a group of assets rather than on a single asset.
Let's see. Again, people asking for examples of policies on the estimated useful life of capital assets. We don't have any of those here at the state library at this point in time. So it'd just be if someone came up with those and sent them to us, and other people ask us for those, we would be happy to give them out. Our insurance agent has estimated amounts of coverage for our assets. Can we use their estimates?
Yeah, if it's a replacement cost type estimate, yes, you can, but you would need to use that consumer price index table to deflate it, I guess, to the year that you purchased it. So you would still have to go through that calculation. The capital asset ledger doesn't show replacement cost on it, it shows historical cost.
Historical cost is my biggest question with donated land or nearly, and a building that has been added onto 4 times with 4 historical records in our files. I assume you're going to get into that here in a bit.
Yes, and
Okay.
Donated property is shown at the fair market value at the time it was donated.
Okay. Let's see. How do we get a copy of the slides? I've posted the link to that in the chat. Trista said years of service for the library or the individual book.
Well, you do years of service for the group of books. So we'll get into that a little bit too. Again, it's another estimation that's involved there because you're going to have different books that last different lengths of time.
So she also followed up with, are we seriously talking about looking at the age of individual titles?
We'll talk about that in some examples.
Okay. Who is looking at our financial statements and wanting this data? You said mostly the bond companies. Let's see here. Doesn't our insurance company already take care of replacement value?
The insurance company would provide you with a replacement value, yes.
Can you verify that there is no maximum that we can list as our what qualifies amount? I'm a tiny library and I see me recommending my board change this to whatever that max is.
There is no maximum, but again, that maximum is going to have to be reasonable. You wouldn't want to exclude every asset that the library has and set a maximum of, $100,000. Like I said, the Government Finance Officers Association has said most units would use something like 5,000, but then they're, depending on the size of your unit, it may be more or less than that. We're just looking for a reasonable amount. Go ahead, Todd.
Right. So like at the Indianapolis Marion County Public Library, their threshold would be different than a small town library in Southern Indiana. It's going to vary. And while it's correct, there's no maximum amount, you don't want it to be unreasonable. So I go back to that term reasonable again. Whatever they set, if it appears reasonable, we aren't going to question that. It would only be if you set it at, like Susan said, $100,000, then we might have to have a discussion as why you picked that amount.
Is land separate from the property our buildings are set on, or are we estimating the value of property our buildings are on?
Land and buildings are separate because land is not a depreciable item. So you would need to split those out.
If our library software can calculate the value of our book collection at the beginning and end of each year and can give me the dollar amount of books added or subtracted each year, I don't understand why we need to depreciate. Seems like the actual depreciation is built into the fact that books are constantly being deleted due to loss, damage, or age.
Well, in that case, you're showing additions and reductions to your actual capital assets, yes, but it's not showing the allocation of the cost of those assets. So I hope that that'll become more clear as we go through a couple of examples related to books.
Kelsey said, is there a way that you would be able to compile a list of the recommended companies to help and email them to us all? I can send out the chat, but I don't want to send out something saying that these are recommended companies from the state. So let's see here. To clarify, if the board wants to raise the capital asset threshold at this time, they can?
Yes, they can.
They just need to amend, if they already have the threshold, they just need to amend, that document and increase it. If they don't have one, then they need to establish one at whatever they want.
All right. I feel like we maybe only take a couple more questions here because they're just flying in, and I think, we maybe won't get to the material that we need to address that might answer some of these questions if we don't put a stop on them just for the moment. But I'll do two more here. Can you please address the question about using the actual collection costs that library software can calculate versus depreciation? I think maybe
we'll get to it.
We talked, okay. And when we adopt a threshold policy, will that take place retroactive to purchase or moving forward?
Most of the time that would be moving forward.
Okay.
Is that right, Todd?
Yeah, I suppose if you were doing it today, you could make it retroactive to the first of this year, but you couldn't make it retroactive to 10 years ago. And if you were doing it today, I think the best practice would be, as of January the 1st of next year, our threshold is going to be X amount of dollars, since we're so close to the end of the year.
Okay, yeah, we'll go ahead, Haley, and then why don't you just, whenever you want to interrupt us for questions, feel free to do that. And that way you can determine what our time frame is going to be, because I want to make sure we get through everything.
Yes.
So, okay, well, we'll go ahead and go to library land. The kind of the structure of this presentation is to go through an example for each category so that you can see how to handle that. So we'll start out with land. That's included on the capital asset ledger at historical cost, which is the same thing as your acquisition cost. It's possible that you'll have to estimate that historical cost, which you can use your fair market value times the consumer price index factor we talked about a few minutes ago. Your county assessor might have that fair market value information. I think they should have that information. You might have historical records at the library that has approximate land values. So you will need to do some estimating there. Land is not depreciated because it has an indefinite useful life. So you're going to show that in that very first category on the AFR of non-depreciable assets. So we'll take a look on the next slide about how that looks in your capital asset ledger. So just looking at the top for the capital asset ledger, you'll see we purchased land in 1964. The original cost was $100,000. So we just show that under land and total fixed assets, and that's what our capital asset ledger looks like. And then when you go to record that in the AFR for this year, you're going to have a beginning balance of land of $100,000. And then if you don't purchase any more land, it would be $100,000 at the end of the year as well. But in our case, we're going to purchase an acre next to the library in 2021. So I've purchased that now for $50,000. I see that I should have put the location of the asset and the original cost of the asset in that column. It was $50,000. So you might make a note of that. But in the column under land, there's $50,000 added, and then total fixed assets, it carries over to that. So now I've recorded that purchase in my capital asset ledger. So what does that look like then on the annual financial report? Okay, so on the annual financial report, remember I started out, and this is the second box. I started out with my beginning balance of 100,000. I purchased 50,000, and then that's going to go add on over to make my balance for land $150,000. And again, that's not depreciated, so that's all you've got to do with land. Now, the next category, which works similarly, are works of art and historical treasures. Also, maybe some of your libraries might have some artifacts that could be that you have on display, which might be included here. Now, currently, those are included in the capital asset ledger at historical costs under books and other. Historical cost is the same thing as your acquisition cost. If these items were donated, then they would be shown at the fair market value on the date of acquisition. Again, we're looking for reasonableness here and some kind of documentation of that. We've been asked if you can show those rare book items or artifacts in a separate column on the capital asset ledger to get them out of books and other. We're not going to take exception to that on the capital asset ledger if you add a separate column for those to make it easier. But when you put them on the annual financial report, you'll have to put them back into books and other to show them that way. Now, for estimated historical cost, maybe you can get an idea from auction sites or publications related to that type of asset. Again, the donated ones would be shown at fair market value at the time of that donation. And also, works of art and historical treasures are not depreciated because they have an indefinite useful life. So they too will be shown in that top category on the AFR. And some examples of those would be paintings, if you have a rare book collection, or some artifacts. Okay, construction in progress is another category that is not depreciated for those of you who might be in a building project at the time. You do include those in your capital asset ledger at historical cost, which is the construction cost that you're incurring at the time. Construction in progress is not depreciated, so it too is shown in that top category on the AFR as a non-depreciable asset. And then for construction in progress, when the project is completed, then you're going to move those costs to the appropriate category, which is usually going to be buildings. So we'll show you an example of that. Okay, so I have my capital asset ledger, and in 2020, we started a new children's wing. And in 2020, we incurred costs for that of $500,000. So I've got that in the original cost of the asset. And then if you follow that over to the column for construction in progress, I show that there for total fixed assets of $500,000. And that's going to be my beginning balance for construction in progress on January 1 of 21. Now for my annual financial report, it's just merely showing the beginning balance then taken right off of my capital asset ledger of 500,000. And then that's going to be my ending balance, possibly at December 31 of 21, maybe. But for us, for my library, that new children's wing was actually completed in 21. So I wanted to show you what happens when you record the completion of a construction in progress and you move it out of construction in progress to buildings. So you can see in that box at the top on the first line, 8/1/2021, the new children's wing was completed. And I take out the $500,000 for construction in progress there. I'm going to remove that because I'm moving it over to buildings. Now in 8/1/21, our children's wing was completed, but in 2021, I had additional costs. So that $750,000 is the $500,000 that I moved, plus another $250,000 that we incurred in 21. So that's how we arrived at that. So just to go over the wording there at the bottom, once the project is completed, you remove those costs that have been accumulated in construction in progress and then show them in buildings. So for in this example, our project was started in 2020 and completed in 21. In 21, we removed the $500,000 that was accumulated in construction in progress for 2020, and we placed it into the building category. In 21, we also incurred an additional $250,000 that was also added to buildings for a total of $750,000. Then on the AFR, you're just going to show that at the top, the top one is like it matches the capital asset ledger. So you'll show construction in progress with a beginning balance of 500,000, and then you'll remove it, right, in 21. So it'll be zeroed out. But then under the depreciable asset sections for buildings, you're going to show in the additions column that 750,000 and add that in to the building costs that you already have for the old part of the building. Okay, so we'll move on to depreciable assets. We'll talk about library buildings for a minute.
Let's go ahead and answer a few more questions if we can.
Okay.
Just because they ever keep coming. So, scroll back up here to Melissa. Can you provide useful resources for estimated useful lives of assets?
I don't have a particular resource that we've used. I know that there are tables available. If you Google that, there are tables available.
From Cheryl, what improvement or equipment is separate from the building? Is the HVAC system and chiller separate? Are the VAVs and the ceiling separate? The light fixtures, the carpets? Are you going to get into this?
Probably not going to get into that, but those things are affixed to the building. So we would consider those to be, they're permanently affixed to the building. So we would consider those to be part of the building cost.
Okay. Does the change in FA policy require a board resolution?
Yes.
Let's see here. What if we never had a policy? Do we include every little item we purchase?
Well, in your policy, you're going to be including your capital asset threshold, right? Your depreciation method, and also at least where you're getting the information for the estimated useful life.
It might be helpful to explain in what is material to one's financial statements. That may help libraries determine a threshold.
Todd, do you want to tackle that one?
Again, I go back to reasonable. Because what's going to be material at a small library isn't going to be, a high dollar amount. It's going to be material at a different library. So I think you just have to look at how your library operates, what kind of, annual revenue and expenses and cash balances you have coming in, and just make that that can help your board in making that determination of whether $1,000 is appropriate or $5,000 is appropriate, or $10,000 is appropriate to set as your materiality level.
Is it acceptable to use the values for land and improvements that are calculated by the assessor's office? For example, our land is valued at $7,700 and building real $95,000.
That's acceptable to use to consider. Yes, that's acceptable to use, but that's considered a fair market value amount. So that has to be applied to the historical cost table or consumer price index table.
So that's where you would, so that's where you would take that, whatever that $9,000 number was for the land, and try to determine when the land was purchased, and then use that factor that's in that consumer price index that we talked about earlier.
So for a small library with a $5,000 threshold, do we only include books as a capital asset, or do we include furniture as a whole and bookshelves as a whole? Because individually, other than my building, land, and books, I will not have anything over $5,000.
Right now, we are considering just the books to be included as in a group basis. Again, because it's the main function of the library, so those would be considered something that should be included in the capital assets if the purchase of books for the year exceed the threshold that's adopted.
Do land improvements depreciate? I have parking lot lighting, irrigation, cubing, sidewalks, and retaining wall listed.
Yeah, those are considered improvements other than buildings, and yes, those do depreciate.
Okay. Someone said we don't even own our building or the land.
If you don't own it, then you would not put it on your capital asset ledger.
Yeah, these are only things that are owned by, your library that you have title to, that you purchased, you own.
On works of art or historical treasures, is your capital asset threshold applied to each piece or the collection as a whole?
That would be up to the library and how they want to handle that. So they could just put that in their policy, I think. Would you agree, Todd?
I would, yeah.
Are we ever required to recognize appreciation of value in land and other non-depreciable assets?
I'm sorry, I glanced over and read something. We're not accounting for the appreciation in land. We're just accounting for the historical cost, if that answered the question.
Let's see. We have a couple people asking if they can have an extension on this in order to get a handle on it. They just don't think that they'll be able to have it done by March 1st.
I would say get as much as you can for the annual report and get it in there. I don't know that, we can't grant an extension to file the annual report. It's due by statute, 60 days after the end of the year, which is March 1st. I would just do the best that you can, and keep in mind that once you submit your annual report, if you get new information or more information or need to go back into it to make changes or corrections, you can't unsubmit it and enter data that you need to and resubmit it. That resubmitting is important. A lot of people forget to do that when they unsubmit and make a change. Resubmit that, and you could do that up until the time we audit that year. Once we audit that year, it's locked and you can't unsubmit an annual report in Gateway. But I would do the best you can to get whatever information you can get in order to submit it. And as that process goes on, if you're not going to have it done, you can go back in and unsubmit and enter information.
I'm going to do 3 more questions here and then we'll continue. We don't own the building that our branch is located, so we only count the assets such as books, computers, etc. What about bookmobiles?
Bookmobiles would be included in machinery and equipment.
If we used our judgment in the past for listing the useful life, even though we didn't depreciate, but we find a list somewhere and use that to create the useful life policy, should we change the useful life we had listed in the past?
You don't have to change the useful life policy that you had in the past, but if you do, then that would need to be noted in the policy that it's changed.
My question is, if we never had a threshold policy, what do we include? Every little item such as a $100 TV when our new policy includes a threshold of $5,000?
If your threshold is 5,000, then you wouldn't record that $100 TV on your capital assets. You would only, if you went out and bought a really big screen, TV that costs $5,100, then you would include it because that TV was over 5,000.
Okay, let's continue.
Okay, so we were on buildings, I think, maybe the next slide. So for library buildings, yeah, I think we went over this. They're included under depreciable assets, and then straight line depreciation would be the best practice for library buildings. I know some of you have Carnegie library buildings that may be a little challenging to find a value for those, historical cost for those. Just remember, again, estimated historical cost, and it can be estimated, is fair market value times that consumer price index factor, or a reasonable estimate based on historical information or knowledge of the time period, which you may have at your library. Using that consumer price index table, if we have an example that your Carnegie Library to rebuild the same thing would cost $2.5 million now, and that building was constructed somewhere around 1914, then you can take that $2,500,000 times 0.04, which is the factor for 1914, and come up with $100,000 to show on your historical cost, estimated historical cost for that asset. Now you can notice here on this table, sometimes you don't have to have the exact year. For example, if you go from 1916 down to 1913, it's 0.04. There's a long period of time from like 1930 to or 1921 to 1930 where it's 0.07. So really just estimating that time frame would be all right as well. Okay, so library buildings, let's just show on the capital asset what it's like to record the historical cost of the library. My particular library on this example was purchased 1/1/1964, and the original cost was $400,000. I used an estimated life for this example of 80 years. I used 80 years only because the math is easy. You can decide, what estimated useful life you want to use for a building. It could be much longer than that or shorter for that matter. But over in the categories then, I show $400,000 under buildings, and I carry that over to total fixed assets. And then for the annual financial report, I have this building as of January 1 of 21 at 400,000. There is my beginning balance. And then that's going to carry over if I have no additions or reductions to that building. Oh, and so go on to the next slide, Todd. Okay, good. So for the library building then, let's talk about depreciating that. So my library was $400,000 originally. I have an estimated useful life of 80 years. So the formula for to calculate annual depreciation, we had this on a previous slide, is historical cost divided by the estimated useful life. So in my example here, I have a $400,000 building. I am allocating that cost over 80 years. And that is going to mean that I depreciate that building by $5,000 per year. Now, we have to come up with a January 1 accumulated depreciation amount balance, as if we'd always been depreciating this library building. So that's not too hard. It's just the accumulated depreciation amount is equal to the years in service. So my building's been in service for 57 years times my annual depreciation amount of $5,000. And that means that my accumulated depreciation balance for that building is $285,000 on January 1. Now to show that on the AFR, remember this first box here, governmental activities, depreciable assets, is just right off my capital asset ledger. It's my value of, not my value, my historical cost of my building at 400,000. The second box is going to show my accumulated depreciation that I just calculated of $285,000. Now, oh, can you go back one, Todd? Sorry. The $5,000 addition, remember my my annual depreciation amount was $5,000 on this building. As of January 1, since I've had this building for 57 years, it's $285,000. But for 21, I have to add another year's worth of depreciation. So that's why that $5,000 is in there. So I need to calculate my beginning balance, and then I need to add whatever depreciation I have on the building for this year. Okay, improvements other than buildings are going to work really the same way. You're going to include it on your capital asset ledger at historical cost, which is the same as acquisition cost. You might have to estimate your historical cost, which again is fair market value or replacement value times the consumer price index factor. You're going to include these on the AFR under depreciable assets, and some examples are like your parking lot or drives or walkways or fencing, or maybe if you have a fountain, that type of thing is considered an improvement other than buildings. And those are best depreciated through straight line depreciation. So to show you again an example of that on the capital asset ledger, I have some fencing and some landscaping from 7/1 of 2000 that originally cost $5,000. And I have an estimated life on that fence of 10 years. And that's the period of time that I think it would be appropriate to allocate the cost of that asset. Again, that goes over, carries over the $5,000. Improvements other than buildings is $5,000, and total fixed assets of $5,000, and then that just records my existing fence. Now, government activities, depreciable assets, this is just right off my capital asset ledger. Again, my beginning balance is $5,000 for that building, or for that fence, sorry. Okay, so to calculate depreciation then, the formula is the same. Annual depreciation is historical cost divided by estimated useful life. So I have a $5,000 fence. I divide that by 10 years, and $500 is the amount of cost for that asset I'm going to allocate over the various years. That's my annual depreciation. Accumulated depreciation is just going to be my years in service times annual depreciation, which would be $500 times 10 years is $5,000. And note my fence has been in place for much longer than 10 years, but I still have it. So I'm going to leave it on my capital asset ledger, but it is fully depreciated. So I don't keep depreciating the fence after the 10 years has been accumulated. So my accumulated depreciation on that is not going to change for this year. You don't continue to depreciate an item after it's reached its estimated useful life, but you do keep it on your capital asset ledger, and you keep it in your accumulated depreciation balance until you remove it. So you can see here improvements other than buildings off of my capital asset ledger. I have $5,000 for that fence. And then my accumulated depreciation down at the bottom as of January 1 is $5,000, because that fence is well over 10 years old now, but it's still working. Okay, on the next slide, let's say in 2022, I want to remove that fence and I want to build a new one. So I removed that on July 1st of 2022. I'm not sure how I set that up on the next page. And then I subtract that $5,000 from improvements other than buildings and total fixed assets. So if you change it out, then you're going to remove it. Okay, so on this example, on that first line, I have my main fence that I had before. That's my old fence. And I decided to go into 2022 on this, but I think it was supposed to be 21. I'm not sure why 22 is there. Okay, so I removed the fence and landscaping. So improvements other than buildings, I subtract that $5,000 out because that was my old fence. And then I built a new fence for $20,000. And then I carry that over to my fixed assets. So to record the purchase of a new fence, you'll record the cost in the capital asset ledger, just like you would any other time. And then for depreciation purposes, remember it's easiest to add a full year of depreciation for that new asset in the year of purchase. And then you'll show the annual depreciation of the new fence and the accumulated depreciation, which would be $20,000 divided by my estimated useful life of 10 years to be 2,000. So I'm sorry, I don't know why that said 2022 on the other one, but let's take a look at this. We have improvements other than buildings of 5,000, it's my original fence. I added a $20,000 fence and I removed my $5,000 fence. So that shows on my capital asset ledger. And then for accumulated depreciation, I had my original fence in there was fully depreciated of 5,000. I've added $2,000 in depreciation, right, for my new fence. That's my first year. And then I've taken the accumulated depreciation from my old fence off. And all of that was in 2021. Okay, machinery.
All right. We have a lot of questions that have come in. So let me see here. Starting with, if our board changes our threshold amount, does this new amount use just from this point forward or used for the total capital assets ledger?
I think, Todd, correct me if I'm wrong, but I believe that if you have a new threshold, let's say the threshold was $500 and then for 2021, they adopted a new threshold of 5,000. All of those assets that are under 5,000 would be shown as a reduction in 2021. They would be taking those off of their capital asset ledger at that point. Was that your understanding, Todd?
Yes, because
Okay.
those are, your board has said those are no longer considered, material because we set our level so high to up to 5,000. So you would take those off and show us the disposal.
If we start making changes, corrections on how these assets are reported, this will change the beginning balance. How will this be handled?
I think we're going to cover that in a question later, but I would show them, I wouldn't change the beginning balance. You're going to want your ending balance from last year to match your beginning balance for this year. Any changes that you're taking off, show them as reductions or disposals in the AFR for this year. And then you'll have all that documentation. If a question comes up during an audit and maybe somebody says, why did you have so much of a reduction this year? And you can show them what items you took off because maybe your materiality level changed or whatever, excuse me, and you would have that supported.
I thought bookshelves were part of a building. Are they supposed to be listed separately?
Well, it might depend on if the bookshelves are affixed to the building or if they're freestanding bookshelves that can be moved. That's kind of a legal determination on that. But if library shelving, if a library shelf is purchased and that's below the threshold, then you wouldn't have to be listing that.
Is the materiality threshold for new assets added that must be reported the same as the materiality threshold for erroneous or irregular variances, losses, shortages, or theft of non-cash items, or can these be different numbers?
They can be different numbers.
Would construction of a courtyard be improvements other than buildings?
Yes.
Do I use FMV X Consumer Price Index to find out how much land improvements depreciate, or is there something else I should use?
That would work.
If our library has the original Carnegie building but added onto it in the 70s and planning to add onto it in 2022, would that have any effect on the dates we use for date of purchase?
Well, the date of purchase for the original building would be the year that you acquired that original building. And then if there are any additions to that building, additions that would increase the service capacity of that building, then you would show those in the year that those happened.
Is a repair to the building considered a capital improvement?
No.
Where are you getting useful life of a building at 80 years? The max life on the depreciation schedule is 39 years.
You know, I used that for ease of math. That's and I thought I was going to say that, maybe I missed it, but yeah, that was just a number that I used. You can use whatever number is reasonable for your library.
Does the depreciation show up on the capital assets ledger or just on the annual financial report?
Depreciation is not on the capital asset ledger. It's on the annual financial report.
Shouldn't the fence, I think this is referring to the old fence on that chart, shouldn't the fence have zeroed out on the asset ledger?
It should, the $5,000
Yep.
fence should have zeroed out.
Okay.
I thought I had a $5,000 and a subtraction of the 5,000, but if that slide needs to be changed, I can send that over to you.
Okay. If our threshold is $5,000 and we pay over $5,000 for an annual software, we do not need to include that on our asset schedule because it does not have a useful life of more than 1 year, correct?
That's correct.
Have library built 1916, addition and total renovation 2006. Can I just use the 2006 figure and eliminate the 1916 figure, or what should I do?
Well, it probably depends on what really happened. If you still have that building from 1916, if they'd like to email us, maybe we can talk to them more specifically about that.
Can the board set a threshold of $10,000? When a new capital threshold is established, do you drop the items off the asset ledger that are below that amount, even if it's a cost for a building?
Yes, if it's below the threshold amount, you would reduce those from the capital asset ledger.
Okay. We've done a few large projects that included a lot of smaller improvements throughout the property, but were not billed for anything individually. Do I need to track down the individual cost of all the things done or track it as a group?
Do you have an answer for that, Todd?
No, can you, excuse me, can you read it again? Did it say they were billed individually?
Probably. It says a lot of smaller, no, it says they were not billed for anything individually. It was a lot of smaller improvements throughout the property.
I guess I'm hung up on not billed individually. If it was a project like a courtyard someone mentioned, and that wasn't billed, individually, like here you pay the contractor, here's the X amount for the courtyard, that would be what you would pick up as your capital asset. But I may not be answering, I may be misinterpreting that question.
Let's see here if she has. I don't see anything right now. Let's see here. Let's see, I understand that Lake County Library shared a spreadsheet with ISL of calculations to achieve these depreciation requirements and that it was shared with SBOA. Will that spreadsheet be disseminated and acknowledged as an acceptable template for all libraries as we navigate this? We wouldn't say that this, when we share something that someone has shared with us, that doesn't mean that we are approving it. So we can share with you what other people have shared with us if you request it from us, but we can't say officially that this is the thing to do, at least from ISL standpoint. What do you think?
It's the same for Board of Accounts.
Yeah.
Yeah.
Okay, let me see here. If you only consider depreciation, how are you getting an accurate picture of what older libraries are worth?
Well, I think they need to keep in mind it's not what something is worth. It is what the cost is and allocation of that cost over the useful life of of that asset. So if it's an old building, even though it might be worth a certain amount, if you were to sell it today, that goes to what the fair market value is. And for enhanced regulatory, we're just concerned with the historical costs.
This may have been answered, but if my board sets the threshold higher than it currently is, can they put in the wording that that amount is retroactive?
Yes, I think if it was retroactive to the first of this year, if it was retroactive to previous years, I think that might be a little too confusing for everyone. So it could be retroactive to the first of this year.
All right, let's continue on.
Okay, so we'll go on with machinery, equipment, and vehicles, and this works a lot like the other categories that we just talked about. Still included on your capital asset ledger at cost. Again, that would exceed the threshold. You can estimate that historical cost if you need to. And examples of this are vehicles, like maybe you have a bookmobile, groundskeeping equipment, like maybe a tractor, a copy of an expensive copier that exceeds the threshold that the library owns. Again, on these, the best practice would be straight line depreciation. So if you take a look here on the next slide, we have a bookmobile. The cost of that was originally $50,000 and the cost allocation was over 10 years. So we've just taken that across and put that under machinery, equipment, and vehicles for $50,000 and then carried it over to the total fixed assets. Again, the estimated useful life, that may be different. This is just an example on how to do that calculation. So calculating depreciation is the same as it has been on all of the other assets up to this point. Annual depreciation is historical cost divided by the estimated useful life. So my bookmobile costs $50,000. I divide that by 10 years, and that's $5,000 per year in annual depreciation. If I'm going to come up with a balance on January 1 of 2021, as though I have been depreciating this all along, I'm going to take that $5,000 times the year that bookmobile has been in service, which for us was just in 2020. So it's been in service one full year. And you can adopt a policy to show a full year's of depreciation for the year in which the asset was purchased. So to show that on the machinery, equipment, and vehicles category for the annual financial report, this first box here, the $50,000, that is just matches your capital asset ledger that this bookmobile has been purchased. And if you come down here, the accumulated depreciation up to this point was $5,000, but I'm adding another $5,000 for this year for 2021. So my accumulated depreciation then carries on over to $10,000 for the bookmobile. Now let's say in my machinery, equipment, and vehicles, I buy a tractor in 2021 for the groundskeeping. I'm going to record that purchase like I would any other. I'm going to put the original cost of that asset as $8,000. I'm estimating the useful life of 10 years. That may be something different for your library. Machinery, equipment, and vehicles is $8,000 then in that column, and it comes over to total fixed assets of $8,000. Depreciation is the same as calculated for other assets. It's the $8,000 purchase divided by the 10 years cost allocation to be $800 per year. Now remember, you can adopt a policy to recognize a full year of depreciation in the year of purchase, regardless of when you purchase it through the year. So for the AFR, you can show an annual depreciation for the new tractor as an addition to accumulated depreciation in 2021. I think that's on the next slide. This top box up here matches your capital asset ledger, right? We had the $50,000 bookmobile. We bought an $8,000 tractor. So now my ending balance is $58,000 for machinery, equipment, and vehicles. For accumulated depreciation, I had $5,000 for the bookmobile already. And I added, remember, $5,000 for the bookmobile plus an $800 for my new tractor to come over to the accumulated depreciation amount for machinery, equipment, and vehicles. Okay. I'm going to move on to depreciable assets. I know there's going to be a lot of questions in this section, so we want to make sure that we get through it. Talk about library materials, and I have 2 examples for you. Before we get started, like we talked earlier, library materials would be grouped together. A lot of people will group all of their circulating items. Maybe you want to group all of your circulating items. Maybe you want to group them by different types. That's up to you how you do that. But I do have a couple of examples, so we'll try and get through those. And just know that I'm only giving you 2 examples of how this could work. There are many examples of how this could work, and I'd recommend maybe you might want to do some research on that. We have a book called Accounting for Capital Assets for a Guide for State and Local Governments. This is the book that I have read. There's many books out there, but this just happens to be the one I've read, and it's by Stephen. His last name is Gauthhier, and that's put out by the Government Finance Officers Association, if you care to read that book. Okay, so library materials are included on the capital asset ledger at historical cost because they, even though individually these items would not meet your threshold, they are the main function of the library, so they should be grouped together. The estimated historical cost, if you need that, is the same. You know, you could take a replacement value times the consumer price index factor if you need to. I doubt that you need to do that for your library books, but you could. You could also use an average book cost from a reasonable source and document that. If, for example, you know that you have $100,000 books, but you don't know the cost of those books, you could use some reasonable average cost for that. Or you can use an average book cost from your own experience if you need to do an estimated historical cost for your collection. Now, library materials are included in books and other on the annual financial report under depreciable assets. And examples are books and DVDs and circulating items owned by the library. Items with a useful life of less than 1 year would not need to be included or would not be included in this category. So there's a couple of best practices. One is to use the composite method of depreciation, which means you group similar items together and you depreciate them as a group. And to do this, you're going to have to define your method and make some assumptions in your capital asset policy. We'll go over again some examples. Now, I have on this slide some common assumptions for library collections, and this has come from research from that book I talked about. It's come from looking at different states' procedures for library collection. So a lot of different places. You don't have to use these assumptions. You know, it's not required. We'll just give you some examples of the type of assumptions that are out there. You may not like these for your library, and that's okay. But here's some examples. 1, the library collection is recorded on the capital asset ledger based on the number of circulating items that you have times a per item average cost. That's an okay assumption as long as you're documenting, you know, where or how you determined that per unit average cost. The library collection is recorded on the capital asset ledger based on the actual cost of the items. Obviously, that's would be the best information available. All library materials are depreciated over the same estimated useful life when you're using the composite method for your entire collection. And we've seen estimated useful lives of 4 years, 5 years, 10 and 15 years. Your library would have to determine what's reasonable for your library materials and what you have in your library materials. Some libraries will say that a full year of depreciation is taken in the first year, regardless of when those books were put into place or those materials. Sorry, I'm going to use books and materials interchangeably. I know that there's more included in library materials. An asset like a book is the disposal of that. When it's disposed of, it's considered fully depreciated in the year of disposal, regardless of how long it's been in service. Some libraries have adopted that type of policy, and we can go on over an example of that. An annualized amount is automatically deducted from accumulated depreciation each year based on an average, or and annual depreciation and reduction is calculated at year end. These are some different assumptions that you could make if you want, or you can come up with something similar on your own. Okay, so one of the main problems that we have with the library materials is just getting started, right? We have to have a beginning balance as of January 1. So the first thing you're going to have to do is determine what's included in your library materials. Is that all items that circulate? Does it exclude newspapers and periodicals? You know, you need to include this information in your capital asset policies. I've seen some capital asset policies that says everything that circulates is considered library materials and is depreciated as a group. We've seen that. We've seen other libraries that have broken it down more by types of items that circulate. Either way would be fine. So to determine a starting point for the historical cost of your collection, obviously your accounting software report is going to be the best information. If you have that cost information in your accounting software, you know, that's what you're going to want to use. If you only know the number of items purchased, but you don't know the cost, then you might have to do some estimating there. And you might do that based on the number of items in your collection, time your average price. You might be able to find an average unit cost, maybe in the Indiana Library Statistics reports. You might be able to use the school library journal average book price. You might want to use an average book price based on your own experience, or and then use a consumer price index factor. But hopefully you have all of that in your software report and you don't have to worry with those estimations. Okay, so I have two examples for library materials. And we'll go over both of those and then we can open it up for questions. Okay, so I've made some assumptions for this first example. One is the estimated useful life of all of my library materials is 5 years. I have written down here, just for reference really, the formulas for calculating annual depreciation, historical cost divided by estimated useful life, and accumulated depreciation, which is the annual depreciation times the years in service, but it's only up to 5 years because that is the estimated useful life of my library materials. Now here's an assumption that you may or may not like, but it's the one that I have for my example, and that is accumulated depreciation includes only 5 years of depreciation, since that is the estimated useful life of the group. I am assuming that the library materials that are 6 years old have been removed from the collection for depreciation purposes. Okay, so in this example, in my first column here, I know the amount spent on library materials from my computer software for the last 5 years were in these amounts for a total of $1,250,000. In the next column, I have set my estimated useful life to be 5 years, like we talked about. And then, so in the third column, I am going to come up with my annual depreciation amount. So if you look at the top line, 2020, I had spent $250,000 on books. If I divide that amount by 5, then I come up with my annual depreciation amount of $50,000. And then those books from 2020 have been in service for 1 year. And so if I multiply 50,000 by 1, then my accumulated depreciation for my books for 2020 is going to be 50,000. And remember, at this point, we're trying to get a starting point, right, for accumulated depreciation. So I do that same type of calculation all the way down to 2016. I have the amount that's spent. I divide it by the estimated useful life to come up with my annualized or annual depreciation. Multiply that by the years in service to come up with my accumulated depreciation. When I add all of that together for my accumulated depreciation as of January 1 of 2021, I get $770,000 for my example. So on the next slide, you can see we have library materials here. The original cost I have is $1,250,000. That's what I added up all 5 years to show as my original cost for those assets. I have estimated useful life of 5 years. And then I just carry that on to books and other, $1,250,000 under books and other and total fixed assets to record my historical costs starting on January 1 of 21. Now on the government activities depreciable assets, that's that second box on the annual financial report that matches my capital asset ledger. You can see I have a beginning balance then of $1,250,000 and my ending balance there without recording additions or reductions yet. Okay, so on this slide, the first verbiage at the top and all those bullet points, that's the same. So we don't need to reread that. And actually this chart is the same. I just wanted to focus on the annual or on the accumulated depreciation. Remember that I calculated my accumulated depreciation as of January 1 of 21 or December 31st of 20. And I came up with $770,000 as if I'd been depreciating my book collections all along. So on the next slide, in the annual financial report, in the accumulated depreciation section, I would have books and other of $770,000 for accumulated depreciation as of January 1. And then that's not counting for any additions and reductions yet. That's just my starting balance, because remember, we need a place to start with on this. Okay, so let's say in 2021, I purchase $125,000 worth of books. Okay, so on my capital asset ledger, I've got my library materials I've started out with that I still have, $1,250,000. And then I'm going to add my 2021 holdings of $125,000 that I've purchased. So that's going to be to record that. Okay, now I want to show you how this works on that chart again. Again, all of that verbiage at the top is the same as it has been. Those are just my assumptions restated. But take a look at this chart. You can see by the red arrow, I've added 2021 now because I'm in year 2021. So my amount spent on library materials is $125,000 for 2021. And notice the green arrow is 2016. So that $275,000 based on my assumptions for reporting the capital asset in the capital asset ledger and for depreciation purposes, I'm going to assume that the materials I bought in 2016 are fully depreciated and should be removed. Okay, so I just wanted to show you that part for now. So let's go on to the next slide. You can see here, again, the 2021 holdings, I added the $125,000. I've removed $275,000 for the cost of my asset for my library holdings, because that was my assumption that the 6th year would be removed. And then it shows the same thing on the depreciable assets section, which matches the capital asset ledger. Okay, on this example, again, this is the same chart that it was before, but I wanted to show you this time the annual depreciation column. So for 2021, I have the amount that I spent on library materials this year, dividing that by the estimated useful life to come up with an annual depreciation. Okay, so I've done that all the way across down to 217 because that's my 5th year. So I'm calculating annual depreciation based on those 5 years. 2016, I'm not depreciating because that's fully depreciated now, and I'm going to be removing that from accumulated depreciation based on my assumptions. Okay, and then on the next, oops, go back one, Todd, please. Yeah, on this one, I want you to look and see again, annual depreciation times the years in service is going to be your accumulated depreciation, which is going to come down to 715,000. So you can remember that number. All right. So for the accumulated depreciation section, remember I have my starting balance of 770,000. I added depreciation of 220,000 that was on the previous slide. That was my addition. And then I took $275,000 off of depreciation because I'm assuming that those library materials have been removed from the capital asset inventory by now because they've exceeded their useful life. And then I arrive at my ending balance of 715,000. Okay, so that was that example. That again is a big estimation, right? I estimated I had my estimated useful life. I assumed that once they reached that estimated useful life, they were removed from my assets and from accumulated depreciation. Now you don't have to do it that way. That's just an example. Like I said, there are many ways that you can do this. But let's go through a second example, maybe not taking so much time on it, but just so that you can see there are other ways to do this. So for example number 2 on my assumption, I've again used 5 years for my estimated useful life. Annual depreciation, accumulated depreciation, those are calculated the exact same. But the 4th bullet point is what's changed in this example, and that is assets are removed based on historical costs of items removed in the year of disposal or removal, or an estimated per unit cost if you don't know the actual historical data for those assets. So on this one, I have the same materials. I have the same amount, but the amount spent on library materials is based on my computer software. So I know in 2020 I spent 100,000, in 2019 I spent 75, and so forth. I do that very same calculation of annual depreciation. I've got for 2020 $100,000 divided by my estimated useful life of 5 to arrive at my annual amount of 20,000. Okay, and then that is going to come down to an annual depreciation amount. And then I multiply that by the years of service to get my accumulated depreciation. Okay, so the only thing that's really changed on this is my assumptions. And you can see this information here would be in the AFR. This top box would match my capital asset ledger. And the second box would be based on my depreciation amounts. All right, now I want to show you how this would work then in 2021, because you might like this example better. In 2021, the amount I spent on library books was $125,000. Okay, I'm doing the same thing. I've got estimated useful life of 5 years, coming up with my annual depreciation amount, my years of service, and then my accumulated depreciation. That's all at that red arrow. But what I want you to notice is that down here at the bottom, I have an amount for 2016 still, even though my estimated useful life is 5 years. I know in 2016, I purchased $200,000 worth of materials. And I know that prior to that, I have records that I have $525,000 of circulating materials on my records from dates that are prior to, or years prior to 2016. And that's fine to go ahead and keep it that way. That's very accurate to do that if you have that information in your computer software. Now notice in the second column though, my estimated useful life is still 5 years. So for 21, 20, 19, 18, and 17, I'm going to go ahead and calculate depreciation on those because I'm allocating the cost over 5 years. For 2016, I'm not going to calculate depreciation again, or those books that are prior, because those have already been fully depreciated. But because I'm not assuming in this one that my 6th year drops off. I'm going to leave that on there because I know at my library exactly what I get rid of. So I'm going to leave that in the accumulated depreciation for 2016 and prior this time. What you see for my library now is I know exactly what I get rid of, and I know exactly the historical cost of the items that I get rid of. So I know that I got rid of $25,000 worth of library materials in 21. So I can subtract that from the total amount that I have for library materials, the group, and I can subtract that from accumulated depreciation. Now say that maybe your library, there's 2 ways to look at this one. Maybe you know the actual cost of those items that were removed, or maybe you have an estimated per unit cost and you know just how many things you got rid of that year. So for example, if the average cost of something in your library collection is $25 and you got rid of 1,000 items, maybe you could show 25,000 based on that assumption. But for my library, I think we knew exactly what we got rid of. Okay. So on the first box there that matches my capital asset ledger on the AFR, I started out with $1,250,000. I added $125,000 from 2021. And then I also got rid of $25,000 from those items that we took out of our collection. And I have an ending balance at 21. On accumulated depreciation, oops, can you go back one time? Thanks. In the accumulated depreciation, I have my beginning balance. Remember that says if we had been calculating depreciation all along. I added 130,000 and took out 25,000. Again, this was the items we got rid of to arrive at my ending balance. All right. So just overall, when it comes to the Gateway Capital Asset Schedule, you're going to want to confirm that your annual financial report beginning balance agrees to the capital asset ledger. That's that, that first box for non-depreciable assets and the second box for depreciable assets should match your capital asset ledger amounts. You'll post your additions and reductions from the capital asset ledger for 2021. And then you're going to confirm that your ending balance agrees. You also need to calculate accumulated depreciation as of January 1 of 2020. And then you'll need to put the additions and reductions for that in there for 2021. So I'm sure there's lots of questions now, so we can go through those. Haley or Todd can go through these that are on the slides, whichever you prefer.
Let's take care of the questions we have in the chat right now. Let's see, back to 11:08. To Kelsey. Kelsey said, I'm still not 100% understanding how appreciation is important. Why does the bond company not want to know what the land is worth at this point and not what was paid for it 100 years ago?
They might be concerned a little with what the value of the land is now, but they were satisfied when I think in a perfect world, they would want to have GAAP statements from everybody, not just those dozen or so that are component units of another government. So they have let us know that if we were able to provide them the depreciation amount and depreciation expense in a year that's been allocated, that gave them enough comfort with the enhanced regulatory cash basis financial statements.
I feel like some of my assets have already completely depreciated. For example, my bank of computers were purchased through a grant 20 years ago. If their lifespan was only 10 years and they're still kicking, that's just good for us, correct? They don't technically need to be on the capital assets ledger unless the last 10 years we've purchased any new ones.
If you still have the asset and you're still using it, it should still be on the capital asset ledger. You would not continue to depreciate it, but it would be included in your depreciation balance.
Can you group computer equipment?
Yes, if the library wants to group computer equipment, they may do that and use the composite method of depreciation on those.
How do we transition between the cost of library materials as we've been tracking them to the use of a new method this year?
Well, that might be something we'd have to address specifically. I don't know if there's enough information in that question to answer that.
If the board wants to change our threshold from $5,000 to $10,000, is this acceptable?
It could be, depending on if that seems reasonable for your library. You know, that might be reasonable for a really large library and not so much for a really small library.
Given the rate of inflation, are we locked into an average cost for the future, or is that changeable at some point?
That's changeable. It just needs to be in your policy, how you're going to figure that.
If we add our materials collection for the first time on January 1st, 2021, can we begin depreciating the whole collection as if this is the first year of service?
I guess it would, well, I don't think I know the answer to that. I don't think so, but we can, if you can write that one out, Haley, and who that is, we can get back with them.
Okay.
Do you have a quick answer to that, Todd?
No, other than I agree with you. I'm not sure that would be the correct method to do the right way.
Yeah.
If we weed constantly when things are no longer usable, then wouldn't we be getting more accurate info from the value of our current collection instead of all these estimates for depreciation? It seems like this is less accurate and much more work. And again, why?
If you have the actual information, obviously you would want to use that actual information. Estimations are needed when you don't have the information available.
So after we determine the useful life of something, that is how long we need to go back for the estimation. Books on your example has a useful life of 5 years, so you went back to 2016.
That's correct.
Let's see. Remove for the capital assets list doesn't necessarily mean remove from our library shelves.
In that first example I showed, yes, that was just an assumption that that was the amount that was going to be removed for the capital asset listing, but it did not necessarily mean that a particular book was removed.
Our software gives us an exact value of the items we did each year. So depreciation includes what was expected to be removed.
It can. Yes. When you do your capital asset ledger, you are going to you can remove the exact historical cost. You know, if your computer system gives you that information, you can make an assumption if you want to that when an asset is removed, that particular asset has been fully depreciated, and remove the cost of the cost of that from accumulated depreciation as well, if they want to make that assumption.
Why would the 2021 holdings reductions amount of negative $275,000 be recorded in the original cost of asset column? I think this is for example 1.
Oh, yeah, it can go there. I might have just missed that cell.
Let's see.
It just needs to for sure be shown as in total fixed assets. It would need to be subtracted from total fixed assets.
I still don't understand how we are accounting for materials removed from the collection.
Well, and I understand that because there are a lot of different ways that you can do it. You know, like we only gave 2 examples. One is you account for what's actually removed, you know, what the actual cost of that asset is, you know, which books have been removed or circulating materials have been removed. You know, that's one example. And another example might be a place that doesn't have any idea. I hope, you know, what's been removed, or they know the number of items maybe, but not the cost. And so that's why there are other ways to do that, where you can drop off that 6th year, like I showed as an example, or you can take the number of items that you know you removed and multiply that by an average per unit price based on historical information. You know, and there's other ways besides that too, I'm sure.
Does it apply to all the categories, land, buildings, furniture, equipment, etc., that they would be removed from the capital assets ledger once they have reached their useful life, even if we still have the item?
No, that was an assumption made for the composite method for library materials. Those are different because there's so many things included in the library materials. If you have a vehicle or a tractor or a copier or anything like that, and it's shown separately on your capital asset ledger, then you would not remove it either from accumulated depreciation or the capital asset ledger until you dispose of it.
Do the 2021 reductions on slide 61 just include items that were discarded that had been purchased after 2016, since older items had already been fully depreciated?
What slide number was that?
61.
Okay, and I'm sorry, can you repeat the question?
Yes. Do the 2021 reductions on that slide just include items that were discarded that had been purchased after 2016, since older items had already been fully depreciated?
That 21 reductions that I had on that slide, because this is not the assumption that things just drop off after they're so old. This was, we hang on to everything in our capital asset ledger until we know we get rid of it. So these were items that were purchased any of those years that we know we got rid of that year.
For materials, I take the beginning balance, the inventory at December 31st of the prior year, plus purchases in the current year, and subtract the December 31st inventory balance of the current year to know how much needs to be removed due to weeding or losing items. There is no way to know which years these would come from. Do we just include how we will handle this in our policy?
Yes, you would handle that in your policy. That, again, that is the value of making those assumptions so that you can figure an estimate.
Let's see here. I am getting a little confused because some of the numbers she refers to would come from our accounting software and some from our ILS, and they aren't always apples to apples. The weighted amount I can get from the ILS, but our replacement cost in our ILS isn't necessarily exactly what we paid.
I think that again goes back to the assumptions. If you have that actual cost information, and that's what you're going to be working on. If you need some other type of estimated cost, then you might work with the ILS information, if I'm understanding that right.
Can I use my patron computers as an aggregate cost, or do we have to use the cost of each computer for a capital asset?
Correct me if I'm wrong, Todd. For the computers, they can show those as like if the computer costs $500 and it's below their threshold, they don't have to report those. Is that right? But if they want to show their computers as a composite group, then they can do that. They would just do, they would do it in a similar way to the library materials as far as the composite method of depreciation.
Trista said, can we see an example with the actual amounts given from ILS, like X amount purchase, X weeded, and then how you depreciate that amount?
We can try and work something up with that, or Trista, if you'd like to call us or send us an email, maybe we can do that, and then we can send to make sure that we understand what you're asking, and then maybe we can send that to Haley. Yeah, and she can send that out.
Julie said 50% of actual cost of collection would be so much easier and realistic. After a year, you can replace any book, almost any book, for 50%. And then if we did, it would be gone from the number. This format just seems to never take into account for things that we get rid of without creating a lot of unnecessary work.
Okay, I don't know if I know how to answer that. I don't know what the question was. But just know that there are many ways that you can do it. I'm not sure I understand about the 50% reduction. So if you can expound on that, Haley, if you know, or if you can give me an example, maybe.
Yeah, I think she was just, that this isn't the only way to do things, basically. You know, you've shown 2 examples, but there are other ways that people could do this.
Right.
So based on 5 years use of books, we'd use the calculation of amount of money spent of books in 2016 and subsequent years until current year and going forward. All materials still on the shelf purchased prior to 2016 would be on the list as a group but have no value, correct?
The items purchased prior to 2016, if you keep those on your capital asset ledger until you know that you dispose of them, then they would still be included in your total fixed assets, and it would still be included in accumulated depreciation until you get rid of those.
But they would have no value, or is there a minimum value that they would?
Well, I don't know if I know what they want with value there. The historical cost, if you still own them and they've not made any assumptions, you know, like the 6th year falls off or something, then the historical cost would still be in total fixed assets. Okay. So it's based on cost rather than the value. Is there something I should be thinking, Todd?
I don't think so. If I understood the question, that it was still on the asset ledger, but it's been fully depreciated, then it has no book value because if you know those actual costs. But I don't know, Haley, can you read the question again for me?
Let's see.
Sorry.
So based on 5 years of books, we'd use the calculation of amount of money spent on books in 2016 and subsequent years until current year and going forward. All materials still on the shelf purchased prior to 2016 would be on the list as a group but have no value, correct?
Susan, is that more like your example too, where you know what you're getting rid of and what you're not making the assumption?
Yes, possibly. That person can email us if they'd like to. Maybe we can get more specific with that.
Okay. Books that are weeded, lost, damage, etc. How do we handle these reductions in another line from the depreciation reduction? Do we need to document the different categories of reduction or just lump sum amount?
You can, if you want, you can just do a lump sum amount for those items, dispose of them when you dispose of them.
We have a capital assets policy in our manual that was adopted in 2010. It has been revised and or reviewed every year since. Is this sufficient, or do we need to do a new resolution that includes the assumptions and which type of accounting method we plan on using, etc.?
Well, it depends on what you're in your capital asset policy. I mean, you don't have to change your capital asset policy, but it should include information such as the capital asset threshold, what depreciation method you're going to use, and what reference you have for estimated useful lives. And then on the composite method, any assumptions that you're going to make for your library materials.
Someone asked, would you send a copy of capital assets ledger, please?
Yes, that's actually in the library bulletin. I think it was June 2019. I'll look while you go on to the next one.
Okay. Let me see here. And actually, I'm going to go ahead and paste in the chat real quick just the link to the SBOA libraries page that has all of the bulletins.
Mhm. Oh,
there,
it was September 2019.
okay.
There's a sheet in, I think it's the last page that's attached is the ledger.
Okay. Is it acceptable to have a complete capital assets policy with all assumptions adopted by our board on January 2022 prior to completing the AFR for reporting year 2021?
Yes. Would you agree with that, Todd? As long as it's,
Yeah.
has an effective date of, January 1st or something like that. Yeah.
Okay. How are we supposed to account for lease books we don't own, are on our shelves, but we opt to keep eventually? Do they count from when we began the lease and put them on the shelves, or when we decided to keep them as part of our collection? The ILS will show they were added with the original date, not the date we decide to keep them and change the holdings code.
Part of that'll depend on what your lease has to say, right? If the lease says you're buying it or leasing it to own, then you would put those on your capital asset ledger. But if you're not going to own them or the lease doesn't provide for ownership, then I don't think you have to do that. Would that be correct? You understanding, Todd?
Yes.
Okay, let me see here. So we can use a composite amount for materials, books, DVDs, etc., and then use an individual amount for computers, like $500 each, and don't account for them.
Yes, you can. Yes.
Okay, do we have an Excel of capital assets?
We do not have an Excel spreadsheet for the capital asset ledger. No, but you could, it would just have the columns that are on the spreadsheet that we have in the district library bulletin.
Let's see here. Julie Wendorf's question about all materials purchased prior to 2016 that are still on the shelf but then have no value. Your answer that she should email SBOA. We all need this answer, so please put something together for all of us.
Yeah, we will.
Okay. And there was a clarification for the book leasing. The lease allows us to lease some books and decide later to keep some. It is a mixture. Okay, that is the end of those so far. So let's continue on with the questions that were submitted for today, prior to today.
All right. Some of these we've already answered. So as I go through them, if we've answered it, I may just briefly touch on it, if at all. The first one is currently our book purchases are all separate line items in the fixed asset listing. In other words, every time we purchase books, it is a line item. Is it acceptable to record them as an expense account during the year and then reclassify them as one fixed asset at the end? And if that was your procedure and you had that documented, that wouldn't be anything that we would take exception to. I think we kind of covered this maybe, but this question was kind of twofold, or they're kind of related. We pay our bills on the cash basis, not the accrual basis. Do we need to track capital assets and depreciation, or does it only matter for libraries who use the accrual method? And I think Susan touched on that in some of her slides earlier, that this is going to be for everyone. So it's not just those units that keep their records on the accrual system. Here we had a building originally constructed in 1902, and there's land, and they're listed as one item with the asset cost of $3,400. The original building was raised back in 1980, and they're asking, how do I properly record the disposal of the building but not the land? And since the value of the land and the building weren't listed separately, you'll need to estimate that historical cost attributable to the building and then remove that portion of it from your asset listing. And the estimated historical cost of the land will remain on your asset ledger as long as you own that piece of land. Here we have 2 buildings that were renovated in the 2000s. However, the renovation costs were not recorded. Should we do our best to locate the expenses for the renovations and enter them into the capital asset ledger? And if so, would the asset type be buildings? It's going to depend on the type of renovations that you were talking about. I think in general, the cost of renovations would be included on the capital asset ledger if the renovation increased the capacity of the asset or extended the life of the asset. For example, if you built a new children's wing that increased the size of your library, that's going to show up on your capital asset listing as a part of the building. So it'd be in that asset type. If those renovations were, we just put new carpet down or we painted, those are all kind of maintenance things because you always have to, repair carpet at some point and paint the building. Those would not be included as a capital asset or in addition to your assets. Are we required to depreciate our collection, or can we just add and reduce accordingly each year if our capital asset policy indicates that we will only record additions and reductions to the collection? The prescribed method for this from the Board of Accounts is you're required to depreciate the library collection. The most common method, as Susan has talked about, is that composite method. On books and other category, our books and other category includes artwork. Is that the proper place for artwork? And is there another category that artwork can be moved to? It would be easier to have just books and other library materials in that category. Artwork is to be shown in the column for books and other on the annual financial report. So that's important to remember. We wouldn't take exception if on your records you maybe had that reported separately, but when you get to that annual financial report, you're going to have to combine them into that books and other category. Some artwork appreciates, others may depreciate. Are we required to report on appreciation or depreciation of artwork? And if so, does that mean we have to have an annual appraisal? No, you're not required to do that, have it appraised annually. You're just going to show it at the historical cost, like I think we've mentioned. I don't think we touched on this one. Our capital asset software requires a fund to be listed. Is that the fund that the item was paid from? And what if the items are donated or they're so old that we don't know? Yeah, that would be the fund that was normally paid from to acquire that asset. If the asset was donated, you should just note that the asset was donated. If you have to put it in a fund, just determine which fund would be most appropriate. If it's an operating fund, then just document that and put it there for your system, and that should be sufficient. I'm going to try to get some of these that maybe we haven't touched on then in the last 3 minutes. I think we covered that one. Is it recommended to hire someone to perform a fixed asset appraisal for us as we have no idea what the current value of the replacement costs might be? That's up to you. I think Haley mentioned earlier in the chat, there was some of the discussion about having a professional come in and do that. And we're aware that there are vendors out there that do perform that service, and it does come at a cost. So I think you would just have to make a local determination whether that cost was something your library wanted to incur and have that done, or if it was something you don't want to have to pay for because of the cost. We're in the process of doing an inventory for the first time in several years, and you're finding that there are several items that are not on our capital asset ledger. Oh, I'm sorry, we're finding there are several items that are on the capital asset ledger, but we no longer have. These items were not disposed of this year. Did we record them as disposals this year, or do we adjust our beginning balances? I think I did cover that earlier. Don't adjust your beginning balances. Show them as disposals or reductions in 21, and just keep documentation of why you did that. And that's a good example of why also in our manual, when we're referring to capital assets, is a periodic inventory should be taken. I think we say at least every couple of years, because you're going to find stuff, you maybe dispose of stuff and you didn't take it off. Maybe there was that the bookmobile that you sold, and oops, nobody went in and actually took that off our capital asset ledger. So the inventories are good at pointing those out. In the next minute or two, and as I'm forwarding through these slides, they are all in the materials, and I know Haley's said where they're available on the State Library's website. They will also be on the Board of Accounts website on the library's page under presentation and materials. So that you can read through these, and then we will try to answer those questions that we've asked for, maybe something more specific from the author of that question, and then we can get those type of items back to Haley, and she can distribute. But I think here's a good one maybe to end with. The problem is there are going to be huge adjustments on the ending 2020 balances for depreciation. And we know that. We anticipate the capital asset records and accumulated depreciation are going to show varying degrees of changes based on the implementation of these reporting procedures. So just keep all your supporting documentation for any amounts that are on your annual financial report. Keep those in your audit files for a review during the next audit. Keep in mind that, estimates, if they're reasonable, you're going to be okay. You should be okay. That's an acceptable method of estimates. It's just if something seems not reasonable, we may have a conversation with you regarding where you came up with that, why you thought it was reasonable, that kind of thing. But just as much documentation as you can keep it is always the better for our audit purposes. And then we'll conclude with our contact information, or if Haley has anything else for us.
I don't have anything else right now. I've placed the request for the LEU certificate into the chat there. I want to thank you, Susan and Todd, so much for speaking with us today. Again, this presentation will be posted the next few days on the Indiana State Library YouTube page and also on our LDO workshops page on our website. If you have any further questions about capital assets or depreciation, please contact Todd and Susan. And again, their contact information is right there in front of you. Libraries at sboa.in.gov. And I hope you all have a warm and joyful holiday season.
Thanks, everybody.
Thank you.
Thank you.